Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to take a look at 3 of the best REITs you can buy right now for some high passive income. As interest rates have continued to climb to record highs, the entire real estate sector of the market has seen a major pullback in share price. And due to this drawdown, these companies are now trading at a discount relative to their fair value. And we're going to go over 3 specialty REITs who will all operate in a different manner in a different segment of the real estate industry that all provide investors with some growing passive income every single quarter. And due to the pullback in share price, they now give their investors a very nice starting yield. So if you're looking for some high passive income in the real estate sector, we're going to go over 3 different companies, take a look at their dividend information, some recent financial history, and of course their estimated fair value from Morningstar reports. So before we jump into that first REIT, I am going to ask you to please hit that like button and subscribe. I'm the Gen Z investor, and on this channel we talk about the stock market, go over any major market news, and we also track the progress of my personal dividend growth portfolio as well. So now we're going to jump right in to the first real estate investment trust we're going to go over, and that is ticker AMT for the American Tower Corporation, which currently trades at $159 per share. And as I mentioned, has seen a major pullback over the past 12 months, with shares down over 25%. The company has a market cap right around $74 billion, a very nice high starting dividend yield above 4%, and a price to funds from operations ratio right around 16.3. So this is equivalent to a price to earnings ratio for a traditional company. And if we take a look at that Morningstar report, the estimated fair value per share for this company is at $216, meaning at right around this current price point, you're getting AMT at a discount of around 27% from that estimated fair value point. So right now you can buy into this company with a nice starting yield at 4% that has a strong history of growing that payout every single year, and it's actually considered undervalued. Now, taking a look at their latest investor presentation, how this company operates is that they own cell tower locations all around the world. So AMT will get a long-term lease or purchase a parcel of land, then they'll build out their own tower structure on that individual property. Then they rent out to 4 to 5 different tenants on the tower and the property for long-term usage. And these tenants sign very long-term, non-cancelable contracts in order to use AMT towers. And because of the infrastructure costs of setting up on AMT towers, there is very high switching costs and very low churn in this market. And if we take a look, one thing that's very strong with AMT is their future predictable revenue. In 2022, they generated $10.5 billion of top-line revenue from their properties right now. But due to inked contracts, so already signed non-cancelable contracts with tenants, they have over $62 billion in future revenue that will be flowing into the entity over the next long-term period. So they already have $62 billion of future revenue signed and inked in contracts right now, which is a very strong and consistent area for future cash flow and of course dividend payments to the owners of this company. And if we take a look, 48% of the revenue was generated within the United States and Canada, meaning 52% or majority of the top line revenue was generated from international markets. So this company is well diversified on a global scale. And if we take a look at their financial history, they have performed incredible over the past 10 years. Their top line revenue has grown at a CAGR of 14.1% from 2012 through 2022. From $2.8 billion just a decade ago to over $10.5 billion of top-line revenue in the trailing 12 months. Their EBITDA has also expanded at a CAGR of 13.4%, and their AFFO per share, essentially their cash flow per share, has grown at a CAGR of 12.4% as well. Now, if we take a look at that dividend payment, their current yield is at 4.08%. They pay out $6.48 per share per year, a very manageable payout ratio of 65%, and their 5-year dividend CAGR currently sits at 16.42%. So this company is not only expanding rapidly in terms of their overall operations, they are returning a fast-growing dividend with a CAGR of over 16% to their investors every single year. And if we take a look, they have a 78 dividend safety score, meaning the company's dividend is considered safe and unlikely to be cut anytime soon. So AMT, the cell tower REIT, one of the largest in the world, currently is trading at an undervalued price point, undervalued estimated to be 27% from the Morningstar report. The first specialty REIT definitely worth taking a look at if you want some high passive income into your portfolio. Now, if we take a look at the second REIT, we have ticker DLR for Digital Realty Trust. The company currently trades for $117 per share, and they are up 18% over the past 12 months, but the company is still considered undervalued. They have a yield at 4.15%. They have a price to FFO ratio of 17.8. And of course, if we take a look at the Morningstar report, the estimated fair value is at $155 per share, meaning they are currently trading at a discount of 24% from that estimated fair value price point. So another company with a nice starting yield above 4%, trading at a discount at their current level. And if we take a look at this investor presentation, this is a data center REIT. They operate over 310 data centers in over 50 major cities to 5,000 customers on a global scale. And their top 20 customers contain some of the largest tech companies in the world, including Meta, LinkedIn, IBM, Oracle, Verizon. We also have some major financial institutions with JP Morgan Chase, Lumen, and many more. And we can see some of the top customers aren't even named in this investor report, and their annualized recurring revenue from these top customers is around 49%. So meaning, as a shareholder in this business, the top 20 customers, which are large scale, reputable, profitable companies who are expected to operate for many years going forward, generate half of the revenue into this business, meaning overall you can be somewhat certain that a large portion of the revenue flowing into this business overall will continue to come in each and every year, which is a great sign for investors who are looking for some consistent and growing dividend income. And if we take a look at their historical bookings over time, exactly like we want to see, the bookings amount continues to grow in all segments of their business. And this number gets translated right onto the income statement by taking a look at their net rental revenue, $2.4 billion of total rent revenue back in 2018 that has expanded year after year to over $5 billion of rental revenue in the trailing 12 months, which is absolutely phenomenal. And as the company continues to generate growing revenues, they return this capital back to their shareholders through the growing dividend. If we take a look, their dividend CAGR from 2005 through 2022 is at 10%. For a REIT, for a company that operates data centers, which is a very boring business that often gets overlooked, they generate immense cash flows, immense profitability, and they return that cash flow to their shareholders every single quarter, and they have continued to grow that payout in the double-digit rate year after year as they've continued to grow. So definitely another company worth taking a look at that has expanded operations over time and currently has a dividend safety score of 80, meaning the dividend payment is considered safe and not expected to be cut anytime soon. So Digital Realty Trust is a data center REIT, the second REIT worth taking a look at. This company, although is up 18% on the year, has seen a recent pullback from a price point of around $130 back down to that $117 range. They are still considered to be undervalued according to Morningstar and could provide you with a nice starting yield above 4% and some growing passive income into your portfolio. So the data center REIT comes in at number 2, and after we move on into the third and final REIT for this episode, we have ticker PLD for Prologis. They're one of the largest logistics real estate companies in the world. They currently trade for $109 per share. They're up just over 3% on the 1-year chart. They have a current market cap at $102 billion, a starting dividend yield at 3.2%, and a price to FFO ratio at 19.5. And like we've done for all the companies, if we take a look at their Morningstar report, this is a 5-star company with an estimated fair value at $133 per share and a current price point at $109. They're currently trading at an 18% discount from that estimated fair value. So again, the third and final REIT you can also pick up for a pretty significant discount below the Morningstar estimated value. And of course, if we take a look, as one of the largest logistics real estate companies on the planet, they operate in South America, North America, Europe, Asia. They have hundreds of millions of square feet of facilities on all 4 of these continents. And one thing I find very interesting is that 2.8% of global GDP flows through their distribution centers. 2.8% of global. So all the GDP generated for the entire world flows through a Prologis distribution center, which is absolutely incredible. And if we take a list of their top 20 customers, we have some of the largest and most recognizable brands in the world, including Amazon, Walmart, Home Depot, UPS, PepsiCo, BMW, and many more. And these top 20 customers make up around 20% of the net rent generated from the business every single year. And overall, they have seen some absolutely stellar financial performance. If we take a look at total revenue, back in 2013, they generated under $2 billion of top-line sales. That has grown at a CAGR of 15% over the past decade to around $6 billion in trailing 12 months revenue. Their adjusted EBITDA is also growing at 13% per year. their adjusted funds from operations, 24% annual CAGR during the past decade is absolutely incredible, and their dividend per share is growing at a CAGR of 12% a year as well. So overall, this business is expanding top line sales. EBIT is expanding at the double-digit rate as well, so they're growing profits. Their funds from operations or their cash flows are expanding as well at 24% on average, and they're returning that capital to their investors with a massive dividend increase on average every single year of 12%. And if we take a look, their core FFO per share outpaces the market and other competitors every single year. So this dark green column for each chart represents PLD. Their competitors are blue chip REITs, the REIT average, and the S&P 500 average. And we can see for all four categories for FFO per share CAGR on a 3 and 5 year period, they're outpacing all competitors, and dividend growth CAGR over a 3 and 5 year period as well, they're outpacing all competition. So this company has seen some incredible financial results. They operate one of the leading logistics businesses in the world, and this company also pays out a dividend that is considered safe with the dividend safety score of 61. So now we're going to conclude the episode. In this video, we went over 3 specialty REITs, which were American Tower Corporation, Prologis, and Digital Realty Trust. We have a cell tower REIT, a data center REIT, and a logistics REIT. They all operate in very different manners. They're not your traditional residential REIT or commercial real estate company. These are very specialized operations who get long-term recurring revenue contracts with their customers, which allow for consistent and predictable cash flow into the future that make them attractive to dividend investors. They've all seen operations expand rapidly over the past decade. Top line revenue, EBITDA, cash flows have all been growing in the double digits for all 3 of these businesses, and they've all been providing some double-digit dividend growth as well to their shareholders. And of course, like we saw from the Morningstar reports, all of these companies are currently considered undervalued and definitely worth taking a look at. So thank you for watching the video all the way to the end. Please hit that like button and subscribe if you already haven't done so, and I will see you in the next video.